Do you actually see that readjusting at any point, or will they be more likely to actually cross that line that you say they're getting closer to?
It is readjusting. It has readjusted, actually. So if you take Europe as an example, what we've seen is a strong fiscal action from all European governments with massive numbers, and also for the first time, a plan to use common resources, coordinated resources, and common funding to common debt to face the crisis. So fiscal policy is waking up to the challenge, and that's really good news. It goes in the right direction.
Benoit, I do want to sort of lean on your expertise from being former executive board member at the ECB, because I spoke to a guest earlier who said that we won't see positive interest rates in Europe, a fundamentally steeper curve, or ECB balance sheet reduction this side of 2025. Do you find that problematic?
Well, that's certainly what markets are telling us, and we've got to listen to what markets have to say. That said, it depends a lot on the way the European economy will step out of this crisis, which is honestly very hard to tell. So it is a likely scenario, and really the stake here is about raising productivity and growth in the eurozone, maybe differently from before the crisis, so that the return on capital can go back, and so that ultimately the ECB can raise rates. But the key is really about lifting productivity and lifting growth.
The French government is looking at ways to extend crisis measures with a long-term furlough, turning loan guarantees into partial equity. Earlier, we were talking about the crisis-fighting measures. What are the risks of governments prolonging emergency support in France, but also elsewhere?
Well, it's a transition. It's a transition. I think in Europe, the most acute phase of the crisis is behind us, and we don't see signs of the crisis coming back, the virus coming back to the extent that would require new lockdowns, for instance. You never know, right? But that's not the baseline scenario. And so what governments have to do is to engineer the transition to a path that can be more sustainable. And that it also involves addressing moving from liquidity issues to solvency issues. Lots of firms in our economies will have severe solvency issues, and so instruments will have to evolve to address that.